2025 bingo card that you had to listen to me. I'm here, so you have to. For those that didn't read the invite and got here and then realized it was me, you're in good company. My wife is here today. She gets to listen to me as well. So Stephanie, stand up. Nobody's ever really met you. Yeah, there she is. She probably didn't appreciate that, but I appreciate it. Yes.
Does everyone have a seat? Do you have a seat? Lauren, do you want a seat? There's more chairs. I'll pull out a couple more. Okay, I just wanted to make sure we didn't have too many people not having seats. And then do you need a clicker? I can go grab it.
No, I've got it. We just need to figure out how to.
Sorry. Thank you for your patience while we navigate a new room with a new system with technology. We had it before. Oh. Good, there you are. You're up.
Okay. We did it. That was big. All right, back to my wife. She probably doesn't appreciate that. I drug her in last night. I told her she needed to come, and she said, "Why are you speaking?" I was like, "Well, yeah, so you got to be here for it." My voice does sound a little under the weather. I don't think I am. So if I get anybody in the front row sick, I apologize. That's on me. But what we wanted to do is talk about this survey. We did this workshop recently with another group of mortgage professionals, and it went really, really well. And it was really discussing two types of ideas or two things that we want you to consider in 2025. One of those has to do with you. We'll kind of get into that as well, and the other has to do with the consumer. For those that have been in the business at least 4 years now, you understand where the market was and where it went middle of 2022. And a lot of consumers since the middle of 22, let's say June of 22, have really repeated the same thing over and over again. I'm going to wait till house prices crash, or I'm going to wait till rates go down. I'm just on the sidelines. And they're starting to realize that there's no longer a sideline. If you want to buy a house, you're going to have to buy at the prices they're at now, or even at the interest rates they're at now. If you could go back to your 2023 loans, or actually I think 2022, I'll start there. For those that don't know, my wife's a loan officer as well. That's why she is here too. She's just not coming to see me. We had a nephew that closed on a home, and we remember she did the loan for him, doing like a 6% rate. And it was like, holy crap. Like, we felt bad giving our nephew a 6% rate. But he decided to still buy the house. Well, if you look at where he is from an equity position now in a rate position, he's in a really good spot in comparison to what others in his age group and buying power are able to get. So you're starting to see a lot of consumers coming off the sidelines or deciding to come off the sidelines and considering that they're going to purchase at these higher rates and higher home prices. For those, I talked about this, I think 2 years ago when I spoke here. The owner of Ivory Homes back in, I want to say 2018, had said that in 2008 they said, "Be louder." Okay, I'll try to be. My voice hurts, Brittany. He had said that the Wasatch Front was going to be much like the San Francisco market, the Bay Area. He said, quoting him, "If you want your kids to own a house, don't sell yours." Right? That was how your kids were going to be able to afford a house, is that you were going to pass your house down to them. And that's pretty much lived up to expectations so far. I remember when we first moved up here in 2019. We bought a house for $400,000, and I wanted to throw up. It's like, I'm a banker. If my wife allowed me to have control of the finances, which I don't, but if she allowed me to have them, we would live in a trailer park, and I would have like a Hellcat outside, right? Like, that's how I approach my finances. But I remember at $400,000, I couldn't imagine spending that much on a house. And a year and a half later, we sold that house for almost $600,000. And I will tell you, it wasn't a $400,000 house. It certainly isn't a $600,000 house. And that house is even more expensive from when we sold it 3 years ago. And so a lot of people are realizing, or consumers are realizing, they're going to have to come off the sidelines. The same thing is going to apply for loan officers. A lot of us, and to give you a little bit background for MGIC, we get to go out into everybody's offices. We get to see behind the curtains. We get to see the top LOs, what we call the movable middle, the LOs that aren't performing, and we get to see what makes them successful, what's holding them back, what teams are killing it, what teams are struggling. And one of the consistent themes that we see across any of those teams is there's a lot of LOs that are still on the sidelines. They're going, they're buying into what the experts tell them at the beginning of the year. And you guys have probably experienced this, right? Since at least 23, rates were going to drop, housing was going to level off, and we were going to have this refi boom. We hear this every year. In fact, we're hearing it right now as well. And I'll show you some information on that. But loan officers are having to come off the sidelines instead of every January getting really pumped up, and by March feeling like you've been punched in the face, in the throat, and you're defeated, and you don't know what's going to happen. I'll just wait till next year. They're starting to come off the sidelines and figuring out, how am I going to engage the customer differently, the potential buyer, even my referral partners, so that I can get more of that business and do more. So this is what I would say the last couple years have looked like from a prediction standpoint. I love interrogation videos. If my wife ever goes missing, I will declare this in front of the 50 of you that are here. If she goes missing, I'm in a lot of trouble, because every night I watch interrogation videos of husbands that have killed their wives. I love it. I can't get enough of it. And she's like, why do you watch that crap? It's terrible. I'm like, to me, it's really interesting that these guys thought they could off their wives and get away with it. And you see over a 3-hour, and I'll watch the long form. I'll watch the full 3 to 5 hours. And you just watch these guys break down. So if my wife goes missing, just know you're going to see my face on the news based on my YouTube channel. But this is kind of what the last couple of years' predictions have looked like, right? We came out of 2022. 2022, all the business was done in the first 6 months. Nothing was done after that. In 23, we had a prediction of 1.6 trillion. The market really did 1.325, the lowest market in quite a while, but still a healthy market if you take out 20 and 21 numbers. 24 was a $2.2 trillion. We finished just under 1.8 trillion. And then 25 is kind of interesting so far. The NBA came out with a very aggressive 2.3 trillion. They have walked that back now. We're not even into February, and that has already been walked back. The average is about 1.7 trillion is what we're going to do. So on par of what we did last year. I show you these numbers because if you're waiting for the refi boom to happen, you're going to be in the same place you've been the last couple of years. But if you look at where some of the predictions have been, this is interesting because this is from 2023, kind of where they expected rates to be, the rates being the red line. The dot, does anyone know what the going rate is today? What's the average? I didn't look at Mortgage Mike driving up here. What would you say the rates are? 6.5? All right. So I'm fairly close. I put this blue dot here a week and a half ago when they were low 7s. So we're pretty close. This is where we are expected to be, and this is kind of where we're at. If you look at Barry Habib, he came out and said there are going to be 4 rate cuts this year. That's in contrast to Bank of America, who said there's going to be 1 rate cut in October, and if we even get that rate cut, we'll get rates back down to the 6s, maybe mid 6s to low 7s. So Bank of America has a much more disastrous look. But Barry Habib's the only one that I've seen that said we're going to have 4 rate cuts this year. How many of you believe that? I just want to see.
Would you say it's disastrous or realistic?
What, to have 4?
The 1.
I think it's realistic, right, to have the 1. But we're not going to be. I'm not making the prediction because I was here when someone made a prediction and they were awfully wrong. I'm making no predictions. I'm just showing you the information. It's possible. I like to follow consumer debt that type of stuff is kind of my economic factors. That is my background in retail banking. I spent 20 years looking at people's finances, how they spent, why they spent, all that type of information. So for me, I think that, at least for me, it allows me to draw more direct parallels because it's what's happening in the street versus what the big econ strategies and theories are happening. And I haven't been too far off. Although I haven't made predictions, I've just said this is what it looks like. So this is where we're supposed to be prediction-wise. The blue dot is kind of where we're at. One of the things that we saw recently with the Stratmore survey was that in 2023, everybody that bought a house, closed a loan, refied, whatever they did, more than 55% of the consumers who closed with loan officers had an unfavorable experience. And that unfavorable experience kept them from giving that loan officer a referral. This to me is an interesting statistic because I would expect this in 20 and 21 when business was through the roof and you couldn't answer your phone and every day you woke up you had 10 new loans and you were like, I am killing it. I'm the best loan officer ever. We all felt it, right? And then 22 happened and you're like, crap, what? I was not prepared for this, right? 23, this is when you go back to that crime scene photo, this is the lowest amount of business that was done in the past 8 years, right? So you don't have a lot going on in your life, right? I didn't have a lot going on in my life either. And in that lowest period, more than 55% of the people we did business with said we were not that good. We weren't good enough for them to give a referral. So part of this workshop, and this is kind of going to be a workshop, I didn't preface this before, we're going to pause and I'm going to have you talk with your teammates on some ideas and some suggestions, some best practices that we can come up with, and then share with the larger group some of our ideas. I'll share some of the ideas that came out from the earlier work group as well as how we can tackle some of these problems or how we can make this 55% unfavorable number much, much lower. How many of you think that more than half of your customers you closed loans with in the last 2 years think of you unfavorably? None of us in here, right? It's never me, Chris, right? It's like we had 2 teenage daughters at home last year, and they shared a bathroom, and it was a disaster, complete disaster. And if you ask the youngest one why it was a disaster, she blamed it on the older one, right? And we were like, okay, well, we'll see. Older one goes to college next year. Well, older one goes to college, and guess what's the state of the bathroom? A disaster, right? It's still a disaster, but she would never say. I would challenge you to think in your business what loans have been a disaster, what areas of your business have those gaps so that you can strengthen them so this number drops. You want to work off referrals right now. You want to work off referrals from real estate agents, from builders, from your book of business. And if you're closing loans and you're getting these types of results, you're not maximizing your ability. So let's jump into the survey. Couple pieces of information from the survey. Buyers, the big picture of this survey is that buyers spent a lot more money than they were expecting post-closing. So they went in knowing I needed a down payment to buy a house. What I didn't know is once I bought the house, closed, moved in, I had this big bill that was going to hit me. And in this survey, the average was $31,975. 48% saying that the cost of buying a home was more expensive than they realized. We've got some information in here that will break down what that number is and what it looks like. But 72% of the respondents had regrets. These are people that bought from about middle of 22 all the way through, I'd say, third quarter of 24. So this is a big delta or data dump of information. It's 1,000 people that responded to the survey, and this is kind of the information that came out of it. Those that were surveyed asked if they could do it again, how much do they think they could save? And they believe that if they were to buy a house again, they could save $24,000. So that number right there, or that information right there is saying that my real estate agent and my loan officer did not help me save this money. I feel like now that I bought a house and I were to do it again, I could outperform my real estate agent and my loan officer by $24,000. Pretty interesting statistic, right? Because we're the experts. Now, is that true? We don't know. It's just what they feel. But we can look at some information later in here where we can strip away some of this noise and actually find places that we can help them save money or at least prepare them for what they're spending. Now, like I said earlier, I love consumer debt and what consumer debt is in the United States and how it operates and how it moves us and how it keeps us like chained to the people we work for. We all want to be entrepreneurs, but debt keeps us working for the man, right? At Key Bank, of course, Ted. Yeah. Big bankers. All right, so when I got into banking, it was about 1999. This is what debt, consumer debt looked like in 1999 across the United States. A couple of numbers I want you to consider here, and this will, you're kind of going to be like, Chris, that's insane, that can't be. This number over here, that 2.06, that means the debt to income of that state on average is 200%. Now we know that can't be because we would be completely bankrupt. So I want you to understand what the two different numbers are, how they're getting to that. They're taking overall consumer debt, the average of the household, and they're comparing that to like labor of Bureau of Labor Statistics for income. I want to say like the Bureau of Statistic income for Utah is 42 or 38,000 to 42,000. But if you look at the median income of the Wasatch Front, it's 80,000. Right? So that's kind of where you're going to see some disparities. But what we really want to do is just look at the map itself. If it's green, it's good. If it's red, it's bad. So when I get into banking, this is what it looks like. Pretty dang good, right? Let's fast forward 2 years. 3 years. I'm not that good at math. All right, 3 years. Let's fast forward 3 years. The map starts to make a big change. Does anyone know what happened the year before that would cause consumers to go into debt a lot more than we had been in previous years? 9/11 happened, right? What about 9/11 that caused us to go into a lot more debt? This is consumer. This isn't government. This isn't that the government went out and spent our money attacking foreign countries. These are consumers. Does anyone remember what George Bush was telling us, Dick Cheney, Jerome Powell? How are we going? Yeah, we're going to defeat terrorism by spending money. Show the terrorists we're not scared. Go out and buy. This is also about the time that you're seeing some legislation being introduced by Barney Frank and Chris Dodd, well actually Barney Frank, about buying houses and that everybody should be able to afford a house. That it didn't matter what your debt to income was, the federal government would back it, and so the banks decided they would start lending if they had Fannie and Freddie's ability to back it. So you go from 2002 to 2008, and this is what it looks like. You can understand why we had a financial crash based off this map alone. You compare it from 1999 to 2008, we have a lot of red. The two hardest hit zip codes in all of the United States were 89031 and 89032 for foreclosures. I managed a bank after the crash that covered those two zip codes for Bank of America. And my boss would come in and he's like, hey, why didn't you hit your lending goal for this month? And I was like, bro, look at this map right here. Like there would be like an atomic bomb in those two zip codes, right? And then all the other bad ones were down in Florida, but the two hardest hit zip codes, I had to manage the bank there. And it was pretty difficult to get people to even open a credit card because they had lost everything, right? So this is what 2008 looked like. We'll fast forward to 2020. This is kind of the start of the pandemic. And you see that people have started to save. There's a lot of uncertainty out there. Economics are pretty good. 21 looks even better. 21 was kind of the height of the savings we had, I want to say it was $2 trillion in savings at the end of 21 for the average American had in their savings account. $2 trillion. Do you know where that number is today? Let's say it was a bar graph. This is like the highest we ever had. This is zero. Where do you think the number is? It's negative 300 million or 300 billion now, right? So we're in the negative from a savings standpoint. And you can kind of see that from this map right here. You're starting to see a lot more dark red creep into consumer debt numbers across the United States. The reason that I show you this is because I want you to get into the mind of the consumer when they're purchasing their largest single debt liability on their balance sheet. They're factoring in a lot more than we may consider. We look at debt to income as just what are your payments? What's your car payment? Credit card payment, that type of stuff. But what's the true DTI? If you were to calculate true debt to income, including your cable, your cell phone, all of that, what do you think it would be? You would be well into the 80% on most people. And if you're pushing DTI to 49%, I work with a lender here. They said that their average DTI on their loans is 48%. The average payment is $4,200 a month for their consumer. So you're getting close to that 50%. Your debt to income, like your true debt to income, is probably just over 90%. Not a lot of money out there. Then you factor in anybody that's LDS, and you got to take another 10% out of that. Bro, you are in the negative. You're like over here. So the reason I bring that up is because I want you to understand when the consumer says, I think I could save $24,000 if I were to do it again, maybe. But as consumers, we're not really good at saving our money. We're really good at going into debt. So we want to talk about some of the ideas of how you can help them. Here's what these numbers look like in a graph form. So I get into banking here, and you can see your debt to income versus your total debt balances. We have a gap, right? We have excess money all through here. Look where it is now. Like, is that scary? That scares me. What we've gotten really good at as Americans is living with debt and the stress of debt. If I were to take my grandparents and bring them back to life and put them right here in 2025, they would be back in the grave within minutes. They'd be like, how do you live this way? And I don't know. I'm a banker, so I don't live that way, but people do. But this is what it looks like in a graph form. So it's just really interesting information to kind of get into the psyche of the consumer as we talk about some of this information that came out of the survey. So when they talk about the $36,000, sorry, I was looking at the wrong slide. Here's some of the obstacles that I want you to consider and some of the things that we'll talk about today. 48%, so pretty much half of consumers said that the cost of purchasing was higher than they expected. What are some of the things we do as loan officers that would help mitigate half the people not understanding what the true cost of buying a home was? What are some of the things you do now? Educate. How do you educate, or what does that mean? So if I come in and I sit down with you and I take a loan application. When I walk out of your office, what do I take with me? What do I get that helps me understand or helps me not become this person right here? A fee worksheet, okay.
But that only addresses buying a house. Yeah. That doesn't address.
Yeah, that's my immediate, right? And remember, this survey is post. So once I closed, I spent $38,000 more than I was expecting. Yeah.
You talked about education. I think we spend a lot more time on the front end with borrowers discussing things like you've never owned a home before, and these are some of the things that you can expect as a homeowner to face. So if you're buying an older home, if you've never owned before, you're going to have furniture, you're going to have to keep a yard, you're going to need tools, you're going to need all of this. I think we spend a lot more time on the front end just having conversations about what the expectation is going to be, more than maybe what we did years ago.
Yeah. When we moved up to Utah, I love zero lot lines. You guys know what zero lot lines are? You're going to get to know them here because the standard home back in let's say for the existence of Utah, if you went to buy a home, what was your standard lot size in Utah? Quarter acre. If you had a quarter acre, you were like poor. It's like when I moved here. I'll give you an example. I moved here, and Utah's really good at two things. I always say this. They're good at asking what your name is, and the very second question is, what do you do for a living? And it's like, why do you need to know that? Stop judging me. But I moved here, and people say, well, where did you buy a house? I'm like, Harriman. They go, oh. I was like, oh, well, what does that mean? They're like, you're on the west side of the I-15. I was like, oh, okay. Didn't know that there was like this status thing here, but cool. So then we sold our Harriman house, and I moved to Spanish Fork, which for all of you that know is on the east side of I-15. So then when they ask me, where do you live? And I say Spanish Fork, they go, oh. And I'm like, whoa, this doesn't work out. The rules are if you're on the east side of the I-15, you're better. And they're like, it doesn't count for Spanish Fork. Like, someone should have told me. Yeah, it's like the whole Salt Lake area, right? I don't know these rules. I'm from Las Vegas, okay? I'm learning them as I go, right? But when Steph and I moved up here, our Harriman house pretty much was a zero lot line. But then when we moved to Spanish Fork, we bought a quarter acre. I don't know why we bought a quarter acre. That is way more lot than we need. In Vegas, zero lot line is I could stick my hand out either side of my house and touch my neighbor. We love it. Like, there's no maintenance in the yard. There's nothing to do. Parking's a little tight, but you pull up. Your weekends, you can golf. You have nothing to do in the yard because there is no yard. Right? Utah is going to start going to that to help address some of the affordability issues. So we buy this quarter acre lot that has a lawn on it, right? And every Saturday I have to mow this thing. Well, I got grubs this year, and I didn't know what grubs were. My lawn kept dying, and I just kept watering it more. And I was like, the math isn't working out, right? So I figured out I got grubs. Being the Las Vegas native that I am, growing up in a concrete family, the reasonable thing for me to do was to tear out my lawn and put in a half-circle driveway. So now I have no lawn, right? So, Jennifer, to your point, when I bought a quarter acre, I didn't know the price and the time that it was going to take to keep the upkeep of this yard. Plus, we have a ton of flowers. My wife takes care of those. But now I have no lawn, so I can golf every Saturday. So, it's not discussing kind of those. I would say it's still up front, but those changes, like if you're going from a condo to a single-family residence, there's a lot. You have to buy a lawnmower. You have to buy hoses. You have to buy things you never had before. A snow blower. Yeah. I still love shoveling snow. I've never had it in my life, so to me it's still cool, right? So here's some of the obstacles. Well, these were the obstacles identified in the survey. I look at them as opportunities, right? All you have to do is say, here's what my competition did. Here was the result of my competition. I'm going to work with my clients differently so that I pick up referrals because I'm not doing this kind of stuff. So let's look at the breakdown of the cost. This is what the cost, the extra $31,975, so $32,000 looks like. The $44,000 is if you include the buying agent's fee in there. But for purposes of this, a lot of the surveys came out prior to that change. So this is the cost pyramid. For those that are in the MI world, Candace and I, Ted used to be, right now, if you could get $387 a year in MI, would that be an amazing deal? That would be awesome. That is so cheap. I'll sell you that all day long, right? That didn't have mortgage insurance and some did. And so they just took the total cost across the entire results, came up with that number for $387. If you have PMI, this pyramid, that would actually be $2,100, not $387. But look at the two biggest costs right here. So Jennifer, to your point, your repairs and renovations, furniture, fixtures, and appliances cost $20,000. Now, this is an old number. In the banking world, we've understood this for quite a while. And the reason we understand it is because we know that most people that buy a house put down as much money as they can. Typically, it's all of their money, because what do they want to avoid? Mortgage insurance, because mortgage insurance is of the devil. Yes. One of us were on the same page. Yeah, right? And as an ex-banker, I want everybody to believe that, because if you put all of your money down and you have no extra money, and I know that you're going to have an additional $20,000 in costs in your first year, this is new homes, this is existing homes, this is averaged out. Where are you going to put that money? On credit cards. So as a banker, we knew this. We loved this. You closed a home, we got you a credit card because we knew you were going to run it up. We built our house, and we had a bet in our house. How long would it be? We picked everything out in our house, right? How long would it be before my wife changed something in the house? And it wasn't very long. In fact, we've been in our house 3.5 years, and she wants to do like a half kitchen remodel. We just built the house, and we're having to spend money. We're like part of this pyramid issue, right? But this goes to high interest credit cards, because we want to avoid mortgage insurance. How long does it take for somebody to pay off high interest credit cards or debt on credit cards? What's the average timeline? It's 20 years. Yeah, 20 years to pay it off. How long is mortgage insurance on for? 2 to 5, depending on how good your loan officer is, right? Let's say it's 7 years. It's the longest. It's still much, much cheaper than what you're doing here or what you're doing with the consumer. So if you want some ways to stand out with the consumer or the buyer that is going to be different, you're going to have to explain the 20-year payoff here versus MI. Now, I'm not using this as an MI plug. I'm just saying there's differences of how you approach the market that can help your consumer when they're hit with this $31,000 or $32,000 bill they're not expecting. Here's what that breakdown is on those two bottom lines. So the biggest thing is painting and staining. I don't know anybody that stains on the West Coast, so I'm taking that this is like East Coast. I look at homes in Milwaukee all the time, and they have these absolutely beautiful wooden banisters, old wood fireplaces, so I'm assuming this is more Midwest, East Coast. Painting and staining. Stephanie, that's my wife's name, everybody, so you want to say hi to her, you can. How long were we in our house before we painted it? The house we built. All the husbands in here were like, I've heard that kind of answer before.
We want Stephanie to come back. So, and she's right. All of this is she's right.
It's true, she is always right. I've been married 28 years. This year will be 28 years. And for those that knew me as a kid, all of my friends, leaders, all that type of stuff, whenever they meet Steph, they're like, how do you do it? Thank you for staying with this man. All right, painting and staining is the number one cost, right? So everybody that's buying a house is painting and staining. So from that piece of information there, what would you tell your borrowers as you're sitting down doing the pre-work about this process?
Would you factor in talking to them about tax deductions at the end of the year?
Yeah.
Savings?
Yeah.
Offset the expenses?
Are you tax deductions in, the mortgage insurance, Oh, 100%.
If you're doing it as an investment, maybe you could do some depreciation.
100%. Who do you work for?
People's mortgage.
All right. 100%. I will tell you this. Your IMBs understand that. Banks, credit unions, not so much. If I were to take you into a $100 million producer's office that I was just in last week and sit you down with him and have you listen to his process, what he does, how he gains business and keeps those referrals. And when I say 100 million, this is his own business. He has another 150 million in loan officer production that's within his offices. One of the big things that he does is he's also a financial and tax advisor to them, right? So that'd be a big one. How would you address some of these issues here, knowing that they're going to come up and they're the biggest expense in that pyramid?
I always tell my clients, you've got to have a budget. Like, I want to know the number of what you want your payment to be before we get into the qualifying stuff. Because I think we're fiscally responsible to have them not be house poor, have them not be able to get a couch because they're, living up to Joneses.
Yeah.
So, there's an obligation we have in doing that. First-time homebuyers especially. They don't teach that stuff in schools. We've gone into presentations at schools, and it's like, new stuff to them to hear about budgeting and, about expenses and stuff like that.
So I got that class in school because I wasn't going to graduate, and they had to figure out how to get me one more math credit, but I couldn't get past pre-algebra, so they put me in a class called consumer math. And consumer math was a way to take kids that really had no trajectory in life, or they didn't have high hopes for these kids in life, and they're like, we're going to teach you how to balance a checkbook, right? So you don't get overdraft fees. And so I took this consumer banking class, and it's like what started to interest me in banking and debt and interest and all of that type of stuff. So yes, they do not teach that to our high school kids. One thing that I could tell you that I absolutely loved my wife about was, for her, since the beginning of time, when we got married, credit was the most important thing. We could never mess up our credit score. Credit score was the difference between $80 payment and $180 payment. Just 1 or 2 basis points in that. So I'll give you kind of a worksheet and some ideas here that the other group came up with that helped them in their manufacturing process. All right, so one of the other things that was really, really interesting in the article, and we'll send this article out so that you can read it, was the amount of concessions that the real estate agent wasn't negotiating the sellers with the sellers, that the buyers had to inject themselves and go after some additional concessions. And this is what they came up with. So in this number, I want to say it was like, this one I may be a little sketchy on. 58% of the people surveyed requested additional negotiations, concessions, and 98% of them were successful in getting them. But the realtor wasn't going after all of the concessions that were on the table. Why do you think that would be? Do we have any realtors in here before we trash on you guys? Let's do it. All right. Why do you think the realtors aren't going after all of these concessions? And it may be somewhat of things that are happening with us too.
Maybe the survey went into this, maybe not, but from talking to realtors, I feel like they don't, not all of them, but some of them don't understand the difference in price reduction versus the concession. So maybe they're thinking we need to ask for less price and not ask for concession.
Okay.
And not understanding how that actually benefits by asking for that.
Yep.
I've got realtors that straight up don't want to lose the deal. They feel like they'll profit and lose the deal.
Yeah. Yeah.
Yeah, I echo that. I'm a real estate agent. I'm a dual licensed agent. But I see it that
You get that fiduciary responsibility to your client, right?
you're trying to get them the best amount that they can, and you're also looking at your commission. And the commission is a lot higher than a commission for a loan officer, right, or a loan originator. So they're looking at that money at the end of the closing. And but the concessions, people are coming in line to give $10,000, in the concessions because they don't want to lose that potential buyer, right? Right now, with the economy, with the market, you're able to negotiate a little bit more, a little wiggle room with the seller. But you're right. There's a lot of buyer's agents that are not really showing that, or giving that option, and that the sellers are holding firm to their guns. That I think my house is valued at this, and then they're sticking to their guns. And so, but if they lose that opportunity to sell their house and they have to put it on the market another 30, 45 days, that's where you need to talk and you need to have that expertise to be able to say, this is still a good deal. The market is saturated like this, and you'd be, maybe you can do a little bit more if you can to sell it off. So, yeah.
Yeah, it's not necessarily in the survey, but if you go outside to look at some of the behaviors of real estate agents in the market today, you'll find some of that.
It's hard to find the real story behind stats sometimes because I just had a buy, sell, close today, right? And the sell, man, it's got a lot of issues, like asbestos, all kinds of things had to be done, right?
Yeah.
And we're already giving to $10,000. We knew, hey, we're going to give more. But they came back after the inspection, $50,000 more. It's like, well, that's way too much.
Yeah.
Okay, that's great. You want me to pay for the, whoever's going to be working on it. I mean, a whole breakdown of the whole process, right? But it's like, yeah, that's not going to happen ever. And so you just need to be aggressive on that. On the buy side, there was nothing. It's like you can nitpick everything.
Oh yeah.
And get crazy. Well, the grade is not quite right. We need to have a landscape crew come out and or you could actually just take a hoe and straighten that out yourself. But I think it's the realtors and the loan officers' obligation to have a conversation with people to say what's acceptable and what's not acceptable. And the problem with this is the first-time home buyer came into a house that was already reduced in price, already seller paid closing costs, but they're just nitpicking every single option. It's like, bro, you're not buying a new house.
Yeah.
Your house is 70 years old, and you're buying a fix-up.
Yeah.
Yes, there is some stuff to fix, but I think it depends on the house you're selling.
Yeah, when I go to sell my house, they're going to nitpick that I don't have a front lawn. It's just concrete. They're going to be like, we're from Utah. We want to mow something.
Maybe they'll negotiate to redo the lawn. Huh?
They'll be like, I got to shovel more now in the wintertime. So you bring up a good point. How many of you right now are helping the real estate agent and or borrower negotiate or work through that negotiating? What is reasonable? What is not reasonable? Brittany.
And I think a lot of it too is the buyer's agent needs to call a listing agent before they send an offer and say, hey, what does the seller need? What is the seller looking for? What is it? Time? Is it full price? Is it we should all understand the market that we're in right now. If we don't yet, here's some information, right? I have a buyer that wants to buy. How can we work together to make this work for both parties? Instead of just throwing over, because I agree, if you just throw in an offer and ask for $20,000 in concessions, the seller might be like, that's steep. But if you have a conversation up front between the two agents and find out, hey, here's what my buyer needs, here's what my seller needs, then you opens the door to start requesting them.
One of the things I found interesting in what they were negotiating, these were the top things that they negotiated and were successful on, is if I ask for some type of concession, I get a no. Let's say I'm asking for a seller paid buyer's agent. They say no. What if I go down and say, hey, can you fix fixtures for me, right? So I want $5,000 in, let's say, agent fees. Absolutely not. What if you do $5,000 in fixtures? I can fix out fixtures myself, and I could put a price on that and be like, absolutely, because the true cost to me is maybe $1,500, right? So there's some things in here that if you're not seeing them, from your realtor partners, or maybe you sit down with your real partners and say, hey, here's some that we never thought about that had a 98% success rate, but 44% of the people that were surveyed that asked for additional concessions, this is the route that they took, right? So just some additional ideas that maybe we're not thinking of or we're not seeing in the marketplace.
Well, I can't really read that, but I know that agents can reduce their commission fees as well. But they don't. They try not to, right? But also loan officers can too. They can do basis points and drop as well. So everybody can negotiate and talk and try to help the buyer at closing to have the least amount of pain at closing. So it's a two-way street because I'm on both sides and I'm trying to figure out the right balance as well.
And the one guy in this entire transaction that can't lower their fee is the MI guy, but you hate us the most. So you guys have the ability and you don't. I don't have the ability and you hate me. That's just how life goes, right? All right. Here's some of the things that they would have done differently. When they're talking about that extra $24,000 that they would save, these are some of the things that they would do differently. The first one, I would have negotiated more with the seller. Like we all would, right? So to your point as far as what's the true information in a survey, what can you really get out of the survey? I don't know that you're getting the $24,000 they think that they can save, but can you get $10,000 for them? Would $10,000 be different than your competitor that's not doing anything? The answer is yes. Is you sitting down with the borrower and saying, when you buy this house, when you close, and you walk out 30 days, well, let's say I take the application today. 30 days we're going to close. On your 31st day, be expected to then have this much money go out of your bank account for these reasons, X, Y, and Z. Right? You're going to want to paint. When we bought our house in Harriman, again, Brittany, as she said, my wife's always right, we had a gray house. Right? That was the color that was in. It was gray with a blue undertone. Right? Is that what the house was? Yeah. We painted the entire house gray with a beige undertone. Was that what it was? Perfect. Yeah. Come on. As a husband, how do you like that? Like when she first put up the paint, I was like, I really see no difference. Why are we painting this entire house, right? But we did because we wanted a beige undertone. I don't get those things, but my wife is in charge of the house, so I do what she asks from that standpoint, right? But someone sitting me down saying, Chris, based on my experience, or Chris and Steph, based on my experience, here's what you're going to spend after you close. If you put all of your money down and you have this cost that's going to go on credit cards, that's fine. Maybe that's how you want to manage your money. But financially, let's look at some better ways to structure this deal. Let's look at some of the tax credits that come from mortgage interest or MI, that type of stuff. Here's one of the things that came out of the work group that we did prior to this. I won't make you go through. We had a much longer exercise with this group. So this is a home maintenance checklist that you can get from MGIC. And this is a checklist that if you're going to go out and buy a house, it gives you all the things you should be looking for. For us, coming from Las Vegas to Utah, we're not used to basements. So we didn't know if the basement felt a little damp, what that meant. Not that that's happened, but we wouldn't have known to inspect that. I just learned about, is it radon that gives you lung cancer here? I'm terrified to go in my basement now. Because Utah has the highest rate of lung cancer per capita for non-smokers than anywhere else. And it's the radon coming out of the ground. I'm like, move me back to Vegas. Is that? Yeah. So we should smoke more. we should smoke counteracts it, right? All right. So here was one of the things that this group came up with. So they took this home buyer checklist and they put over here where it says date completed. They put over here on average the cost for a basement repair is $4,500, right? Then they came down here and they said roof and gutter, damaged shingles, $2 a square foot is the average cost to fix that. And they went through this entire checklist. And then when their borrowers come and take a loan application, they go out with the realtor to look at houses, they give them this checklist and they say, if any one of these things needs to be repaired, here's the cost. So you know prior to going into this house, I may want the 3-car garage or the 4-car garage, and my wife may want the one with the bigger pantry, and we may be at a stalemate. But if I know the one with the 4-car garage has a lot more repairs, I may say, all right, let's go with the pantry. And so what this does is it gives your borrowers, if you're not going to have the in-depth conversation up front, it gives them something you could hand to them in your welcome kit that as they're out there looking at these houses, they can make considerations. I really like this house, but it has a $20,000 basement repair. It doesn't matter how much I like it, I'm going to go find something else. Or to paint the house from gray with a blue undertone to gray with a beige undertone is going to cost that. That's worth the price, right? And you can use these, or you can get this off of a website I'll show you here in a second. But the other thing that came from this that the group had come up with is how many referral lines of referrals can you get out of this? Business referral partners could you get out of this sheet? How many do you see? Dozens? All right. So if I have a customer that really wants a house and it needs basement repair, who do they go to? Who do you help them? Do you help them get to somebody, or do you just say Google it? Right. So if I work with a couple of, let's say I have a mason, I have somebody that does roofs, I have somebody that does walls, doors. I have at least 8 on here of referral partners that I can go into my local community. Oh, yeah. I go into my local community and say, I want to work with you. If one of my clients potentially has an issue on this home buyer checklist, I want to refer them to you because I trust you. Now you have somebody that may refer business back to you, right? Instead of just your realtor being your referral partner or your builder being your referral partner, you have at least 8 additional referral partners here that you can start working with in your community, especially if those people are going to buy a rehab home. Here's the people that you could work with, or the people we trust, right? So you can go to this website, it's readiness.com. It's an MGIC website. It's got that checklist. It's just under your resources here. It's got a budgeting checklist as well. So if you want to get your buyer away from that red map, there's some budgeting checklists in there as well. And with that, I just want to leave you with one last thing. Trina Phillips is the new MGIC account manager here in Utah. I have been kicked to the curb. So if you ever have any questions regarding MI from MGIC, feel free to reach out to her. The other thing I do want to mention is Candace, Clayton, all of your MI partners, Alicia, I almost forgot, I had Ashley in my head. Alicia, we all have tools that can help you on the front end of your customer conversations. Please reach out to your MI partners and just see what tools they have to help your business grow. You'd be quite surprised at the time and the money they invest back into you and into your business. And with that, Brittany gave me the I'm done, Chris. It's over, and we'll leave it at that. Yeah, kick you to the curb.
I'm going to pick on Stacey. Stacey came in a little late. She was at a closing. Congrats. But she said, is this trying to talk people out of buying a house? So I said, no, but was this information helpful? Okay, does this help you feel prepared or give you ideas of how you can have better conversations to prepare your clients to buy a home and know that you're actually putting them in a good spot, helping them be prepared so we're not continuing to go darker red on that map? Yes. Okay, does anyone have, well, I know we're at our time, but does anyone have questions? Comments? Yes. Yes. Yeah, I have talked to a lot of people that are looking at new construction that have not even considered, everyone's looking at the interest rate, right? That's all they care about, interest rate, interest rate. They do not consider yard, fence, window coverings, appliances, furniture, whatever, right? They're not even thinking about that. So, no, we're not trying to talk them out of purchasing a home, but we're trying to prepare them so that they're not part of that 55% that said I wouldn't use the loan officer again because they didn't prepare me and I feel like I'm now a financial mess, right? You want to show up and be their advisor, their guide, the person they know they can reach out to help them when they need a contact for somebody. So I hope everyone takes this information and starts implementing. I know I took different notes of how I can have different and better conversations with my clients moving forward. But take these numbers and use this information to say, hey, we want to help you buy a home, but my goal is to also help you be really financially prepared for that. And I want to show you some different things you need to understand about what you're taking on and or some different ideas. I know everyone I've talked to that tells me mortgage insurance is the devil. Once I break it down and say, hey, actually mortgage insurance is this much, it saves you this much money up front, it's going to fall off in approximately this amount of time, and they're like, oh, yeah, that's awesome. Let's do mortgage insurance, right? So you're welcome. So, yeah, use that, take that, and then if you have questions, I'm sure you can reach out to Chris and he can help use those resources and have some better conversations and better prepared clients. So, okay. Thank you all for coming. We will see you February 26th at Zion's at 12:30. And then real fast, does anyone have interest in taking the reverse mortgage certification course? A few hands. Okay, that info will be coming out soon. Highly recommend. So if you're interested, watch for that and hope to see you there. Thanks, guys.
Thanks.